Investing in stocks can be done in many different ways, but besides the known quality requirements, which are aimed to profitability, growth, value, and quality of management, there is also the question of the financial health of the company in which you want to invest. After all, the idea is that the company in which you're going to invest is sufficiently viable to continue operating in the near future so that your investment can pay off. How you can use ChartMill to screen companies on the basis of valuation, growth, or the extent to which they pay out dividends has been discussed before, and I'll put some links in the description below this video. In this video, I will take a closer look at the number of financial ratios that give you a better insight into the financial health of a company and how you can set up these ratios as filters in our stock screener. My name is Christoph. Welcome to ChartMill. Overall, there are four main indicators that contribute significantly to a company's financial picture: solvency, operating efficiency, liquidity, and profitability. So let's start with solvency. Solvency represents the ratio of equity capital to the capital that comes from third parties, so contributed debt capital. The obvious question here is to what extent a company is able to meet its long-term debt obligations. You can find an answer to this by calculating the debt-to-equity ratio to evaluate the company's financial leverage. It measures the degree to which a company is financing its operations through debt and financial liabilities against total shareholders' equity. A lower debt-to-equity ratio is preferable because it means that a larger portion of the company's business is funded by shareholders and not by creditors. This is not only good for shareholders' trust, it also means that the company owes less interest to lenders. Keep in mind, however, that you should only use this ratio to compare companies within the same sector. Capital-intensive sectors will logically have a higher debt-to-equity ratio than companies that require little capital to carry out their activities. To set the debt-to-equity filter in ChartMill, use the corresponding tab in the fundamental menu. Then select the market and a few other basic filters, and don't forget to specify the sector or industry within which you want to compare the companies. How to easily compare the results is covered at the end in this video. How efficiently does a company manage its resources? What operating costs are necessary to achieve the desired result? If Company A, a sector colleague of Company B, achieves the same result as Company B, but does so with fewer costs, then the operating return of Company A is significantly better than that of Company B. As an investor, you are naturally looking for firms that manage to minimize operating costs. A commonly used ratio for this is the operating margin. This reflects the operating profit margin of a company and shows to what extent a company is able to generate profits from its activities. The operating margin is calculated by dividing the operating result by net sales after factoring in variable costs but without interest or taxes. Because only operating costs are taken into account, this ratio is very suitable for mapping the profitability of the pure core business. The higher the margin, the better the company succeeds in effectively turning sales into profit. Higher efficiency. In the context of the purpose of this article, it also means that a company is better armed against economic crisis or specific temporary events with a potentially negative impact. An operating margin of 15% is considered healthy by default. To what extent can a company meet its short-term liabilities? If it can meet those obligations, the company is considered liquid, and this is one of the foundations of a financially sound company. If that company fails to meet its obligations even in the short term, then there is no future for it either. A company that is illiquid will eventually cease to exist, and to measure the degree of liquidity, cash and cash equivalents, which is the cash available in the company and easily convertible assets of that company, are taken into account. To measure liquidity, two ratios are used, more precisely the current ratio and the quick ratio. The current ratio shows whether the company can pay off its short-term debts with the available cash and current assets. If the current ratio is greater than or equal to 1, then the company is considered liquid. However, a ratio of at least 1.5 is maintained to be considered healthy. The difference with the quick ratio lies in the fact that for its calculation, unlike with the current ratio, the company's inventories are not taken into account. Here too, 1 is taken as the standard before the company is considered liquid. This is sufficient too, since the inventories were already disregarded. The quick ratio is also known as the acid test and is a lot more conservative and realistic than the current ratio because stocks cannot always be converted into cash just like that. The quick ratio gains importance in companies whose inventories have a high turnover rate or where the value of those same inventories is volatile or uncertain. The profitability of a business is important for the viability and continuity of a company. Too low a level of profitability hampers further growth and development and therefore new investments. In the long term, this implies a risk. Especially in case of negative profitability figures, the company can get into trouble rather quickly. Profit in itself says little, however. It is mainly the net profit margin that is important. Company A, whose profit is $2 million, may look a lot more impressive than Company B, whose profit is only $400,000. But if it turns out that the total turnover to arrive at that profit for Company A is 50 million and for Company B only 3 million, then that gives a much more nuanced picture. Company A's net margin in that case is only 4%, while that for Company B is over 13%. A larger net margin provides a greater financial safety cushion in case economic conditions deteriorate or costs suddenly increase unexpectedly. Furthermore, a decent profit margin allows the company to continue to grow or pay dividends to shareholders. A good margin will vary considerably by industry and size of business, but as a general rule of thumb, a 10% net profit margin is considered average, while a 20% margin is considered high, and a 5% margin is low. The net profit margin is one of the most important indicators to assess the financial stability of a company. Moreover, this ratio does take into account the effect of interest payments and tax expenditures, unlike the operating margin discussed earlier in this article. The Altman-Z score is not a ratio in itself but a mathematical model that can be used to determine the creditworthiness of a company, both public and private. The model of the Altman-Z score is aimed at predicting the probability of bankruptcy, and to do this it uses business figures that are easy to find for most companies. Keep in mind, however, that this score does not automatically mean that the selected companies will actually go bankrupt. The formula used for the original score is very general, and meanwhile there are also variants available that distinguish more between the type of company. Nevertheless, it is a good tool to use in your analysis that tries to assess the financial stability of a company. In this article, of which I post a link in the description below, you can read some more information about the Z-score. A score of 1.8 or less is a serious indication of a creditworthiness problem. Anything over 3 gets the status healthy, and a score between 1.81 and 2.99 is defined as neutral. To compare companies based on these ratios, it is best to display the results in a custom table, and I will now show you how to create such a table. Make sure you are on the stock screening page, and in the blue horizontal bar, click on the inverted triangle next to View. Scroll all the way down and select Create Custom View. In the next screen, select the button Table View. Select Ticker and GICS sector. Then choose the menu Fundamental Health and select the options Current Ratio, Quick Ratio, Altman-Z and Debt to Equity. Then go to the section Fundamental Profitability and select Profit Margin and Operating Margin. Next, give a name to your designed table, and I'll take Financial Health Ratios as an example, and then click on the Save View. As a test, I will define a new screen filter, and I start with some general settings. So US only, with a minimum price of $10 and some decent volume. And I want to withhold only medium to large sized companies. Now, to display the results, once again click on the inverted triangle in the blue horizontal bar and now select your new table view. The different columns can be ranked from high to low and vice versa. Comparing companies belonging to the same sector is also very easy. In the General tab, choose the desired sector, for example, healthcare. Now only the companies that are active in this sector are shown in the results. When I go to the Fundamental tab and set the debt to equity filter to a maximum of 1.4 and the profit margin to minimum 15%, then the results are automatically adjusted. In the debt to equity column, all the values above 1.4 are disappeared, and the same goes for the profit margin, which I have set to a minimum of 15%. As you can see, such a table is very efficient for comparing companies based on these ratios, and it makes your analysis much more effective. So be sure to try this out for yourself and set the table to fully meet your specific needs. That brings us to the end of this video. I hope you enjoyed it, and if so, don't forget to like it and subscribe to the channel. It is greatly appreciated and it helps us tremendously to grow the channel. Many thanks and see you next time.